Research Paul Tudor Jones' top 3 swing trading strategies, and here they are. Let's get started. Number 3. Microanalysis combined with technical patterns. Let me explain. This is super powerful. Jones often integrates microeconomic analysis with technical trading patterns to identify high probability trades. Here's what made him stand out from others. One of his secrets is to understand the broader economic environment, such as interest rates, geopolitical events, or economic reports, so that he can better anticipate market movements and refine his swing trading strategies. Here are the steps of how he did it. Step 1. Keeping up with major economic events. For example, if a central bank is expected to change interest rates, this could create significant market swings, which could lead to a greater profit. Step 2. Another powerful technique to grab proper swings is to combine these microeconomic insights with technical patterns. Those technical patterns are as follows: head and shoulders, which is very powerful to identify trend reversals; triangles, which is very important signal to identify trend continuation; and double tops and bottoms, which are also signals for reversal areas. Number 2. Risk management and capital preservation. How is that done? Let me explain. One of Jones' famous quotes is, "The most important rule of trading is to play great defense, not great offense." This powerful quote highlights his emphasis on risk management. He's known to use tight stop-loss orders to protect his capital and to cut losses quickly if a trade does not go as planned. This requires advanced money management skills and also advanced stop-loss placing techniques. And here are very important steps of how he did it. Step 1. Apply strict stop-loss levels based on technical support and resistant areas. Let me show you how. First, draw a support and resistant area. Then when you place a trade, very important, your stop-loss should be between 5 to 10 pips below or above the support and resistance area. Step 2. Position sizing should be managed carefully to ensure that no single trade can significantly harm the trading account. That means that you should be risking 2% or less of your trading balance if you are not an experienced trader. Number 1. Trend following with contrarian edge. What does that mean? Well, let me explain. This is very important, please pay attention. Paul Tudor Jones is known for following market trends, but also for recognizing when those trends are likely to reverse. He pays close attention to market sentiment and looks for opportunity to enter the trades when the market is overextended in one direction. This contrarian approach allows him to capture large price swings when the market corrects itself. Let me show you step by step how he does it. This strategy relies on technical indicators like relative strength index, moving averages, and volume indicator to signal overbought or oversold conditions and market strong areas when bigger players are present. The steps are as follows. Step 1. Identifying strong trends using volume indicator, RSI, and moving averages. Step 2. Very important. Before entering a trade in the opposite direction, wait for signs of exhaustion, such as declining momentum. To do that correctly, look at the size of the candlesticks and the amount of the volume indicator. To support this channel, please like and subscribe.